Hello everyone, welcome back to my channel. This is Dr. Rameshri MG, Assistant Professor of Commerce, Government First Grade College, Kumta. We'll discuss BCom 5th semester's Accounting Theory, Unit 5 Accounting Standards, Part 8 Accounting Standards issued in India. In the previous part, we discussed Indian accounting standards from 9 to 16. This part will cover Indian accounting standards 17 to 24. Accounting Standard 17 deals with segment reporting. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 2001 and is mandatory in nature in respect of the following: enterprises whose equity or debt securities are duly listed and enterprises that are in the process of issuing equity or debt securities that will be listed, and all the commercial and industrial and business reporting enterprises whose annual turnover is more than rupees 50 crores. Segment accounting policies are the policies adopted for preparing and presenting the enterprise, as well as those accounting policies that relate specifically to segment reporting. This standard discloses revenue from external customers, revenue from transactions with other segments, segment result by business segment, carrying amount of segment assets, segment liabilities by business segment, depreciation and amortization expenses, non cash expenses other than depreciation and amortization, reconciliation of revenue, result, assets, and liabilities. Accounting Standard 18 deals with related party disclosures. This accounting standard comes into effect in respect of the accounting periods commencing on or after April 1st, 2001 and is mandatory in nature. The objective of this standard is to establish requirements for disclosure of related party relationship and transactions between a reporting enterprise and its related parties. The requirements of this standard apply to the financial statements of each reporting enterprise as also to the consolidated financial statements presented by a holding company. Items of similar nature may be disclosed in aggregate by type of related party except under circumstances. The name of the transacting related party, the description of the relationship between the related parties, the description of the nature of the transaction, the value of transactions either as an amount or as an appropriate proportion, any other elements of the related party transactions which are necessary for understanding of the financial statements, the amounts or appropriate proportion of outstanding items pertaining to related parties at the balance sheet date, and the provision for doubtful debts due from such parties at that date. The amounts written off or written back in the period in respect of debts due from or to related parties. Accounting Standard 19 deals with leases. This accounting standard comes into effect in respect of all the assets leased during the accounting periods commencing on or after April 1st, 2001 and is mandatory in nature. The objective of this standard is to prescribe for leases under lessees and lessors the appropriate accounting policies and disclosures in relation to finance leases and operating leases. This statement should be applied to all the leases other than the lease agreement to explore for natural resources, licensing agreements to use lands. In other words, this standard applies to agreements that transfer the right to use assets even though substantial services by the lessor may be called for in connection with maintenance of such assets. Accounting Standard 20 deals with earning per share. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 2001 and is mandatory in nature. This standard prescribes the principles for the determining and presenting of earnings per share for comparison of performance among different enterprises for the same period and among different accounting periods of the same enterprise. The focus of this statement is on the denominator of earnings per share calculation. Accounting Standard 21 deals with consolidated financial statements. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 2001. An enterprise that presents consolidated financial statements should prepare and present these statements in accordance with this standard. This disclosure should be made in consolidated financial statements, a list of all subsidiaries including name, residence, proportion of ownership interest and voting power held. Accounting Standard 22 deals with accounting for taxes on income. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 2001. It is mandatory in nature for all the accounting periods commencing on or after April 1st, 2001 in respect of enterprises whose equity or debt securities are duly listed and enterprises that are in the process of issuing equity or debt securities which will be duly listed. This standard prescribes the accounting treatment for taxes on income, which is one of the significant items in the profit and loss account of an enterprise. Such taxes on income are accrued in the same period as the revenue and expenses to which they relate. In some cases, the taxable income may be significantly different from the accounting income due to the reasons. Firstly, there are different items appearing in the profit and loss account and the items considered for tax purposes. Secondly, for some items appearing in profit and loss account, deductions are allowable for tax purposes. Thirdly, There may be difference between the recognition of items in profit and loss account and the corresponding items which are recognized for computation of tax. Accounting Standard 23 deals with accounting for investments in associates in consolidated financial statements. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 2002. This standard should be applied in accounting for investments in associates in the preparation and presentation of consolidated financial statements by the investor. This standard specifies the meaning of certain terms such as an associate, significant influence, control, a subsidiary, a parent, a group, consolidated financial statements, the equity method, and equity. Accounting Standard 24 deals with discontinuing operations. This accounting standard comes into effect in respect of accounting periods commencing on or after April 1st, 2004 and is mandatory in nature for certain enterprises mentioned in note given at the end of Accounting Standard 29. Further, this standard is made mandatory for all the enterprises in respect of the accounting periods commencing on or after April 1st, 2005. The objective of this statement is to establish principles for reporting information about the discontinuing operations. This will enhance the ability of users of financial statements to make projection of an enterprise's cash flow, earnings generating capacity and financial position by segregating information about discontinuing operations from information about continuing operations. At the end, India is currently in its process of implementing the Indian accounting standards, which are largely converged with international financial reporting standards. For addressing transition related queries, an Indian accounting standard transition facilitation group has been set up that issues clarifications bulletins addressing implementation issues from time to time. Here we will sum up with accounting standard 16, 17, 18, 19, 20, 21, 22, 23 and 24. References. Thank you for listening.